Tesco, the supermarket where roughly 20 million UK households hold a club card, quietly confirmed this week that it is exploring the sale of its Central European operations, its only remaining international business. The timing is worth examining carefully. Foreign buyers are paying record premiums to acquire UK-listed companies. Takeover offers for British firms have exceeded $231 billion in 2026, a figure 210% above the same point last year, according to Reuters. Tesco's strategy runs counter to that flow. As overseas capital floods into London at a pace not seen on record, Britain's largest grocer is choosing to shed its one asset that sits outside that buyer's reach. The central paradox is this: Tesco is focusing inward at the exact moment when international diversification would give it the most leverage. The question is whether this retreat reflects genuine strategic clarity or a board that has concluded Tesco's domestic market alone can support the growth targets that would justify its current valuation of roughly 18 times earnings. The provisional answer lies in the UK grocery margin structure, which is what the next chapter tests directly.
Tesco's domestic strategy rests on a single structural advantage, the club card, which drives customer loyalty through differentiated pricing visible at the shelf. That advantage has just been legally constrained. The April 2026 price marking order reform makes it unlawful for retailers to give undue prominence to loyalty prices on shelf labels. Where Tesco previously used the club card price as the headline figure, with the standard price in smaller type, the new rules require both prices to be displayed together, with neither given precedence. This matters for margin, not just presentation. Tesco's competitive model depends on making the club card discount feel like the default, not an option. When the standard price is visually equalized with the club card price, the psychological lever weakens. Customers who previously renewed their club card primarily to access shelf discounts now face a layout that makes the standard price equally legible. However, the tension cuts both ways. The same regulation applies to every competing supermarket with a loyalty scheme: Sainsbury's Nectar, Morrisons War. Tesco is not uniquely disadvantaged. It is symmetrically squeezed alongside its primary rivals. The question that actually decides Tesco's domestic thesis is not whether Clubcard loses value in isolation. The question is whether Tesco's superior data from 20 million cardholders allows it to retain its targeting edge even when the shelf display advantage is normalized. That data advantage cannot be legislated away, and it feeds directly into the CEE capital story. The proceeds from any Central European sale would most naturally be deployed into the UK loyalty data infrastructure, the technology layer that makes the club card commercially productive beyond its physical discount function. That is the strategic logic the market is trying to price.
The CEE sale and the club card squeeze are not two separate stories. They are both outputs of the same structural force: the gap between UK and US equity valuations that is driving every major M&A decision visible in the UK market this year. UK stocks currently trade at roughly 18 times earnings, their US equivalents at 26.5 times. That 47% valuation gap is not a recent anomaly. It reflects a decade-long structural shift in which defined benefit pension funds reduced their UK equity allocation from 32% of assets in 2006 to under 2% by 2023, while shifting towards gilts and global index funds weighted towards the US. The consequence for Tesco is direct. UK domestic institutional investors have progressively withdrawn capital from FTSE-listed names. Foreign buyers, private equity firms like Castlelake and Apollo, who competed this week over easyJet at a premium of up to 80%, have stepped in precisely because the London discount makes UK cash flows cheap relative to what those same assets would cost in a US or European listing. Tesco's board faces a version of this calculation every time it considers capital allocation. A Central European business generating cash in Czech krona and Hungarian forints is valued by London's market at a multiple depressed by a UK-specific discount. A sale to a European or US strategic buyer could realize a premium to Tesco's carrying value, precisely because the buyer's home market would assign a higher multiple to those cash flows. Business Secretary Peter Kyle's warning this week that pension funds face potential legislation if they do not raise UK equity exposure represents the first formal policy acknowledgement that this dynamic has reached a political tipping point. Whether that pressure shifts institutional behavior in time to support Tesco's domestic valuation is the variable that most directly connects the macro to the share price. For a holder of Tesco shares, the CEE sale news resolves into a concrete capital allocation question. If the sale completes at a premium to book value, Tesco will return capital to shareholders. Executives have already signaled the direction by purchasing shares at 358.78 pence each through the partnership scheme. That insider activity suggests the board believes current prices do not reflect the post-sale capital position. The counter-evidence in the pool is real. The pricing law strips one of Tesco's most visible competitive levers, precisely as it focuses entirely on the UK domestic market. A company that has just sold its international optionality and simultaneously faces tighter regulation of its primary loyalty mechanism is a company whose UK-only earnings now carry the full burden of the investment case. The variable that most sharply tests this is not the next set of annual results, but Thursday's UK GDP print. The consumer spending component of GDP is the earliest available read on whether British households are maintaining grocery volumes and trading up or down, the single metric that governs Tesco's domestic revenue outlook before any quarterly earnings release. A GDP print showing resilient consumer spending confirms the domestic focus thesis. One showing contraction or a sustained shift toward cheaper own-label goods across all UK grocers undermines it, and in a world where Tesco has just sold its only non-UK hedge, that contraction would have nowhere else to be absorbed. For a watcher considering ESHRI, the opportunity setup requires two conditions to hold simultaneously: CEE sale proceeds above carrying value, deployed into UK data infrastructure, and UK consumer spending stable or growing on Thursday. Both conditions named, one already in motion, one printing in 4 days. That is when the domestic pivot becomes an entry setup rather than a trap. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.